What's up guys, my name is Richard and today we're going to be talking about pros and cons of liquidity pool yield farming. I personally think it's very important to understand what benefits you stand to gain and also a few risks that's associated with yield farming. So let's dive right in. The first benefit of yield farming is that you have cash flow. If you look at my current open positions here, you can see the dollar unrealized loss is pretty bad, right? Because the market has been trending down. But you can see versus just holding the tokens I deposited, I'm still up about almost $7,000. And on the right here, you can see my current APR is hovering around 56% with relatively low volume. And I'm projected to make about $4,000 to $5,000 this month. And if your portfolio was pretty heavy on alts here, like mine was, you can see Ethereum has dropped quite a bit. If you look at the others chart, all other altcoins have dropped quite a bit as well. So by having liquidity pool positions, I have cash flow around $4,000 a month that I could use to either pay for my expenses or to deploy in the market to get more altcoins. So this is very valuable, right? When you have cash flow during downturns, you can then use it to invest and make other plays, while other people that don't have DeFi exposure, they won't have that cash flow and the flexibility to do so. So the second benefit is that there's less of a need to time the market when you're providing liquidity. So a good entry is still important. For example, if we're looking at my ETH and SOL position, I entered the position swapping from ETH into ETH SOL at about 0.06 when priced in ETH. And right now it's trading at around 0.067. So I'm in nice ETH profit from impermanent loss as well as fees. And you can see up here, instead of holding 100% ETH, I'm up about $1,700 something. And the longer a position stay in range, the more likely I am gonna make dollar profit, ETH profit, or comparing against hold. So let me show you guys one position that has been open since November 26th last year. So this is Pixel and ETH. Pixel is a very small cap gaming token that I'm bullish on. You can see right here versus holding 100% Pixel, I'm up about $5,600. Just holding ETH, I'm up almost 10 grand, right? 50-50 or initial asset. I'm up against all of these benchmarks because I've been in range for quite a while. And you can see I've claimed over $5,000 something over the lifetime of this pool, and it's still printing me at about 120% APR. You can see here the current price in ETH terms is slightly above my starting price. So the price didn't diverge much at all, and I didn't really have to trade to make those profits. So you can see this is the result I expect if I stay in position for 6 to 12 months and the positions do well. The third benefit is that you're still doing well, you're still making money in a choppy market. So the toughest environment to trade is probably like a sideways market because you're not quite sure where the market is moving, right? And a lot of people flip-flop and then they get chopped out, right? Versus providing liquidity, the best market is either a choppy market or an uptrending market because your assets are gaining in value and you can take profits, right? You can see back here in August and October to November of last year, the market was quite choppy, right? Not a lot of trades were happening. And if you were providing liquidity like I was, you were still making some nice fees and profit into that pump in December and January. So it's a great way to still make money in a choppy market. And the fourth benefit that I have noticed with liquidity pools is that it increases my patience. So I think it's really hard to predict what prices are going to do short term. You could only see like, okay, these prices I'm willing to buy, right? And I expect certain prices out of things. And even that is not that accurate. But with liquidity pools, I have these fees that make me more patient. I could look at my position, see how I'm doing, versus just buying and holding or using perps to trade. I often find that I get a little bit more antsy right? When I see positions draw down or move against me, like you're paying stuff like funding fee, and it's harder to hold your position for a longer period of time because you're not making money. In fact, you're losing money most of the time, right? But you can see here, even if I average only 50% and I pull in $4,000 per month, in 10 months, assuming the market has gone completely sideways, right, I would still be in dollar profit. So if you're a more longer term investor, it makes sense to get into liquidity pools and learn how to use these tools to your advantage. And another advantage of liquidity pools that you have if you're pairing, let's say, stuff like Ethereum and USDC, is that you suffer much less drawdown. So in one of the examples I have made in the rebalancing video I had an ETH and USDC pool, right? I had rebalanced into this pool, and my rebalance entry was around $36.97. The top range was like $5,000. The bottom was around $22.75. So in that case, I had mostly USDC paired with some ETH. And while ETH was retracing, my USDC got converted to ETH, right? Instead of having purely ETH, my drawdown was much less because I held a large position in USDC and it's being slowly converted to ETH on the way down. And I also got some fees to absorb the downturn. So my portfolio, even though it's made largely with Ethereum and also some very small cap tokens like Pixel, my all-time high to current position drawdown is less than 50%. Compared to a lot of other altcoin investors, if they hold a lot of small cap tokens, they're probably down closer to 70-80%. And if you look at my ETH profit, I'm still sitting at a nice 1.6 ETH profit on my recently opened positions. So again, you suffer less on drawdowns because you have fees to cover it, and if you have USDC pairs, those pairs provide stability and kind of smooth out the drawdown a little bit. And once these markets pump back again and recover, a lot of these unrealized losses would be wiped away, right? And again, the next point is there's higher margin for error. We kind of went over this already. Basically, fees help you cover your margin of error. So hypothetically, right, if I'm averaging 56% APR, right, and even if my positions kind of trended down around 10% this whole year, I would still be up about 40% from just the fees, right? So pretty straightforward math there. And lastly, the last benefit is you're able to compound your gains. So the best time to compound your gains is probably when the market is down because you're buying these alts at a cheaper price. Assuming you believe that the altcoin market is going to recover, I could inject a lot of these. For example, $4,000 here, I could put $2,000 to $3,000 back into these liquidity pools or into new liquidity pools while using the rest to cover some of my daily living expenses, just as an example. And really your portfolio is going to grow year after year if you keep compounding some of your gains, right? If we look at this simple compound interest calculator here, let's say you put 10 years, that's your investment time horizon. You started with around $100,000, and the interest rate is basically how much you compound, let's say 30% per year. You can see I was making around 50%, right? Let's say we chuck up like 20% to impermanent loss. I would start with 100,000, and by year 10, I would have $1.27 million. And during all these times, my income is going to grow over time, right? If I had like $1 million earning like 20-30%, I'm earning like $200,000, $300,000 per year. So that's quite good, right? You compound your gains and you're making more and more cash flow as you invest. So now that you know the pros, let's talk about the cons. The first one is the smart contract risk. A lot of times when you're in DeFi, you're interacting with smart contracts, right? Like stuff like Uniswap or lending protocols. If there are vulnerabilities in those contracts, then of course your funds might not be safe. And the second con is you're basically taking the worst performing asset and the brunt of the hit if one of the assets don't perform well. For example, if I'm providing liquidity for SOL and ETH, If Sol is underperforming ETH, right, then most of my positions is going to be converted into Sol and I have to hold that. And if you're okay with either asset, then that's not a big deal. And if we dive into more degen stuff like ETH and MOG, if MOG doesn't do well, then my whole capital would be converted to MOG. So you're taking on more risk than just buying and holding a small amount, right? Some people misunderstand, like if you put in, like, let's say 50% ETH and 50% MOG in the position, you might think you're only risking that 50% MOG to MOG exposure, right? But in reality, you're risking the whole position because let's say MOG dumps sharply against ETH, then your whole position would be converted to MOG. If MOG doesn't do well in the USD term, you also can't really cash that out at a profit, right? And the next con is impermanent loss. Basically, if the prices diverge a lot from your entry point, then you're incurring some impermanent loss because your assets are getting converted at a certain rate, right? Depending on how wide your range is. I have an in-depth video on impermanent loss. Be sure to check that out if you don't understand it yet. But it could be a good or bad thing depending on your goal. But there always will be a little bit of impermanent loss. And the fourth con is that you need capital to invest into DeFi or yield farming. It's unreasonable to expect just investing $100 or $1,000 in DeFi and then expecting you're going to make like 200, 300% gain per year. And then you're building your portfolio to like 6 figures from $1,000, right? Because a lot of times, like, the higher your APR, the more risks you're gonna take, and the more likely you're gonna lose money, the more risks you take. But if you're investing $10,000, 50% per year is still $5,000, not insignificant at all, right? $5,000 is about like a month worth of income for a lot of people. And if you have closer to, let's say, 100K like I do at 50%, I'm looking at about $40,000 to $50,000 per year. And if I mark about half of that to impermanent loss, I'm still comfortable to take out, $20,000, $30,000 per year. And if you have $1 million earning even 50% per year, that's $500,000 per year, right? And let's say you only take out 10%, that's $100,000 per year. And not a lot of people have that. But even starting with $10,000, I think that's a good starting point. Anywhere below that, I think your time is probably better spent doing stuff like, building a business, earning extra income on the side, or doing stuff like airdrop farming. The fifth con is that you do need some education and experience. It takes time to get into this, to learn stuff like impermanent loss and how to rebalance and what asset to provide liquidity for. And hopefully I help with this part, because if you lack the experience and education, it's more likely for you to lose money. And I share these so that it's easier for you to get started, as well as to prevent you from making major mistakes that could wipe you out. And the con is that it's a bit more time commitment versus just holding. You do need to take some time to manage your positions, and depending on your strategy, I hold mostly wide range positions, so it's much more passive. But from time to time, I do need to rebalance, and I do need to keep up with the charts. And if you stick with major stuff like ETH, BTC, or SOL, then maybe your time investment is much less. So that's it for the video, guys. Thanks for watching. If you guys want to check out how to yield farm, be sure to look at some of my other videos on the channel. It's going to help you get started and hopefully make you some more money. I'll catch you guys next time.